Ladies and gentlemen, good day and welcome to Q2 and H1 FY2024 earnings conference call of Nuvoco Vistas Corporation Limited. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that the company faces. The company assumes no responsibility to publicly amend, modify, or revise any forward-looking statement on the basis of any subsequent development, information, or events, or otherwise. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Madhumita Basu, Chief Marketing, Innovation, North Sales, and Business Development of the company. Thank you, and over to you, Ms. Basu.
Thank you, Yashasvi. Good afternoon, everyone. It gives me immense pleasure welcoming you to the Q2 FY2024 of Nuvoco Vistas Corp Limited. At the outset, with reference to a feedback from some of you, I trust you will be happy to note that we have advanced significantly the board meeting and consequently this earning call dates. We believe this would provide opportunity for the investor and analyst fraternity to have more constructive engagement with us to understand the results and business outlook in the days to come. The Indian economy is picking up steam and strength despite the global challenges. Real GDP growth for Q1 FY24 came in at 7.8% YOY, significantly led by domestic drivers of private consumption and fixed investment. The momentum in agricultural activity in Q2 FY24 has been sustained, although the monsoon has been uneven. According to Indian Meteorological Department, rainfall over the monsoon core zone, comprising most of the rain-fed agriculture regions in the country, was normal at 101% of long-period average. The industrial sector signaled recovery in Q2 as index of industrial production rose by 5.7% in July and core industries output expanded by 12.1% in August. Going ahead, however, current global geopolitical tensions needs to be carefully monitored. Looking internally now at Nuvoco's performance for the quarter ended 30th September 2023. Revenue from operations improved by 7% YOY to rupees 2,573 crores on the back of revenue per ton improvement of 6% YOY. A value-led growth. Our premium product share stood at 37% of trade volumes, while our trade share also increased YOY to 74%, reinforcing the strength of our network. Moreover, as you know, cement prices in the East also improved in September 23. Volumes grew by 1.2% YOY during seasonally weak quarter. Demand in the North region continues to be robust, where we saw a 14% YOY growth. In the East, core markets of Bihar and Bengal saw subdued growth during the quarter. However, we continue to hold ground and remain geared for demand revival in the East. Apart from infrastructure-led government programs, which will drive cement demand, PMAY scheme needs a special mention. Currently, as we speak, 33 lakh houses are pending for completion in the East, and out of this, 14 lakh houses are only in the state of West Bengal, suggesting significant potential for cement demand rising from this region. As reiterated, we will continue to prioritize value over volume growth in the East. In the North, our planned expansion in Haryana cement plant will enable us to cater to strong demand in this region. We delivered a strong growth in EBITDA by 73% YOY, driven by revenue growth and cost control measures. It is important to note that planned shutdowns at our plants for completing annual maintenance and debottlenecking projects impacted the EBITDA for the quarter. Additionally, we would like to remind you that we have stopped accruing incentives from Panagarh facility from April 2023, and Nimbol plant incentive benefits period was completed in Q1, which has, on a like-to-like basis, INR 45 per ton impact in this quarter. As highlighted, the result also demonstrates our commitment to remaining vigilant on managing our costs well. I now quickly share comments on the three major cement cost elements. Power and fuel costs per ton remained flat quarter on quarter. Fuel cost in itself declined due to reduction in coal and petcoke prices and increase in AFR usage. In Q1 FY2024, AFR was 11.2%. This went up to 14.3% in Q2 FY2024. However, power cost increased quarter on quarter due to maintenance shutdown and non-utilization or low utilization of CPPs and WHRs. Cement raw material cost per ton increased 12% quarter on quarter, mainly due to requirement to purchase clinker on account of plant shutdown and increase in slag cost. On the slag, Nuvoco continues to be better placed due to its long-term supply agreement. Distribution cost per ton declined 6% quarter on quarter, primarily due to lower clinker road movement, absence of busy season surcharge in months of August and September, and internal cost control measures. As shared in earlier calls, to improve margins, Nuvoco remains focused on measures such as premiumization, innovation, geo-optimization, trade share improvement, fuel mix optimization, brand strengthening, and Project Bridge, about which I shall be speaking in a bit. Firstly, on brand building, we are reinforcing the premium position of Concreto with our market campaign, Concreto Naam Hi Kaafi Hai. We also continue to reinforce marketing communication with the recent patent received on our revolutionary product, fiber-reinforced cement, branded in the market as Duraguard microfiber cement. The patent, effective from date of application, cites exclusive rights for 20 years. The company also extended premium cement variants, Concreto Uno and Duraguard F2F, from Bihar and West Bengal to Jharkhand market. Secondly, on Project Bridge. This project has been taken up in our company CSA and is under rhythmic review with 2 EXCO members. We are focusing on cost-saving measures purely from efficiency improvement. Areas include optimization of power and fuel costs by improving SHC, SPC, and AFR usage. Elimination of losses in materials transit and handling. Reducing damages and demurrages in transit and warehouse, and improving warehouse utilization. Logistics areas of direct orders, lead distance reduction, etc., and productivity improvement programs. On debt, our net debt at the end of September 30, 2023 stands at rupees 4,734 crores, which is a reduction of rupees 549 crores on a YOY basis. I would like to mention that as highlighted in our investor presentation, historically it has been on a declining trend as our focus on net debt reduction remains a top priority. Interest rate at 8.4% on the other hand reduced by 9 bps compared to March 23 despite repo rate remaining the same. I will now briefly touch upon our ready mix and MDM business. Both businesses are performing well. Revenues from RMX business grew by 11% YOY with a value-added products component of 34% in the mix. During the current fiscal year, 4 new ready-mix concrete plants were commissioned, taking our tally to 55 plants across India. In modern building materials, construction chemicals, tile adhesives, and cover block continue to witness sales improvement, and the company remains focused on building the non-cement channel for this range of products. Sustainability. Nuvoco remains committed to its sustainability agenda, Protect Our Planet, which encompasses a sustainability roadmap, circular economy initiatives, green energy contribution, water positivity, and biodiversity management. I would now like to share the progress on key sustainability parameters. As mentioned during our previous call, we have one of the lowest carbon footprint in cement industry at 462 kg CO2 per ton of cementitious material, duly validated by KPMG for the year FY2023. Our alternate fuel rate AFR has improved 5.2% on YOY basis to 14.3% in Q2 FY24. Chittor cement plant continues to demonstrate capability of approximately 30% AFR, while Rishta, where the AFR feeding system was commissioned in Q4 FY23, has achieved 18% AFR in September 2023. Growth projects. Reviewing quickly the update on our ongoing growth projects. On cement capacity expansion to 1.2 million tons per annum grinding unit at our Haryana cement plant, I am happy to confirm that we have completed no-load trials. The commission is scheduled in Q3 FY24, post which our overall cement capacity will reach 25 million tons per annum. Clinker capacity enhancement through debottlenecking projects at Rishta and Nimbol cement plants have been completed. Rishta and Nimbol clinker capacity is now being enhanced to 12,000 TPD and 6,000 TPD respectively. The Nimbol capacity enhancement will also support our grinding unit expansion at Haryana. On railway siding projects at Orissa and Sonadih, track laying activities are underway. The Orissa operations are expected to commence from Q4 FY24. With this, I conclude my opening remarks. I am joined here by Mr. Jaikumar Krishnaswamy, Managing Director, Nuvoco Vistas, and Mr. Manish Agarwal, Chief Financial Officer of the company. We are here together to answer your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We will wait for a moment while the question queue assembles. We have our first question from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi. Hi, good afternoon. A couple of questions. One on the value over volume strategy. That strategy would imply that management is walking away from certain less profitable markets. If you can maybe talk about, I'm not sure if I missed that in the opening remarks, what those markets could be where you're choosing to walk away from. Is that any particular region? Is that non-trade? Is that maybe lower sales in the New Vista brand? So that's the first question.
Yeah, I guess we're waiting whether you're going to put a second together or not. Good afternoon, Satyadeep. When we mean value or volume strategy, I guess this has been the approach which we have taken for many quarters now. Just that we want to focus on predominantly, but if you have to give a choice between volume and profitability, I think we are very clear that we need to kind of get the overall profitability up, because our end objective or immediate objective is to kind of reduce the net debt so that we can fuel growth for the company. That's what I've been saying in all the quarters, and hence it is just an extension of our commitment to reduce the debt levels of the company. As regards whether we will walk away from a market or not, very clearly in the previous call I also mentioned one more thing, that the installed capacity of the company is 25 million tons, with 6 million tons in north and 19 million tons in east. And right from the IPO time till date, we have been very clearly mentioning that our growth projects in east will be second priority, and before that the growth in north/west will happen. In line with that, we still have a lot of headroom in the east market for the next 2 to 3 years, and hence we are cherry picking premiumization, trade versus non-trade, Duraguard versus double bull, more of Concreto, more of premiumization. That is what we are saying when we say value over volume, and certainly we will not go and sell for the sake of selling and getting volume growth in the market. And even within the core state, our focus will be on those states where our contribution maximization happens, and geo mix is a clear agenda. Just to sum up, value over volume means for us is premiumization, getting the right geo mix right, use the headroom available in east to get the growth numbers for the company in the coming few years, and certainly focus on bottom line to ensure that the reducing the net debt levels of the company in the near future. That's what is our volume versus value number. And also in the monsoon period, generally volume comes down. Then for us, prudent was to ensure that we are able to focus on value over volume.
So, Jay, if you look at the October month, given you've already talked about the volume growth in this quarter of 1% odd, how has October been for you so far?
It's very difficult. I think we just started the quarter, so I guess while September, if you had asked this question a few weeks ago, it would have been close period for quarter two. But right now it's open for Q3, but it's too early for me to make any comment on how this quarter will progress. Suffice to say, with the festivities ending and the monsoon ending, market will open up from November onwards, and I guess once the Chhath Puja is done, I think it will be a little bit of home stretch all the way from Chhath Puja all the way to March 31st. And we will leave no stone unturned not to kind of grab if something's available there. But certainly, I guess we won't sell for the sake of selling in markets where we don't make adequate contribution. And also focus will be on trade versus non-trade.
Okay. Just one more question on premiumization on brand Concreto. When we started this journey about 2 years ago during the entire listing, at that time, Concreto we understood was the premium brand in the entire East, in the entire premium brand and all. But our channel checks seem to indicate that some peers, including Ultratech, have now gained pricing premium. Would that be correct? And if that is true, how does the company plan to regain that premium pricing for Concreto in that region?
So, Satyadeep, thanks for the question. You will appreciate that on this call, I would not like to make a specific comparison with any competitor. However, to place certain facts relevant to address your query, there are two aspects to premiumization. One is the share of premium products in the mix, and second is the absolute premium per brand vis-a-vis the band of competition out. As you know, at 37% of trade sales, we are one of the highest in premiumization. Within this, in the key markets of Bihar, Bengal and Jharkhand, premiumization trends to about 65 to 68%. Secondly, driving realization improvement from premiumization is a key lever on our DAP, and we continue to remain vigilant on market price tracking from both internal and external sources. So, on a database and a band of competitors in the market, from base product, the band of premium for Concreto, depending on state and competitor product, is anywhere between 15 INR per bag to 35 INR per bag. Finally, I'd like to round up by saying that this is a continuous process for us. And last year when we launched Concreto Uno, we are bettering our own price game. Concreto Uno is priced 20 INR per bag higher than our Concreto product. I trust that addresses your query. Thank you.
Thank you so much. I have one question and come back in the queue. Thank you.
Thanks, Satyadev.
Thank you. We have our next question from the line of Jashandeep Singh from Nomura. Please go ahead.
Yeah, hi. Thank you for the opportunity, and I hope I'm loud and clear. So I have three questions, and I hope management will be able to answer them. The first one is, every call, and since the IPO, we are saying that net debt, deleveraging is our priority. We also set a target for around 3,000 to 3,500 crore before we do any expansion. But the debt keeps on increasing. It's around 47 billion right now. So I just want to understand where the management is saying net debt by the end of this year, and what is the long-term strategy to actually delever. So my first question is regarding this.
So that sorry, I think we had, now you're unmuted. I guess you'll hear me. If you really look at our investor presentation, chart number 23, we have very clearly shown debt levels of the company, March 21, March 22, March 23, and the same comparison for September 21, September 22, and September 23. I'll just read out some numbers for you. It will provide you adequate clarity on the question which you asked. March 21, the debt level of the company was 6,730 crores. September 21, it was 5,718. March 22, 5,064. September 22, 5,283. March 23, 4,414. September 4,734. Every quarter of March, every September of the last 3 years, our net debt is continuously coming down. You made a statement that we are increasing our debt, which is factually not correct.
Sir, if I may,
let me finish my answer,
March,
then you can put a riposte.
Sure.
March 21 to March 23, every quarter, 6730, 5064, 4414. September 21 to September 23, 5718, 5283, 4734. And you also mentioned that from IPO time, I am mentioning our company will reduce the debt level. Of course, our commitment is to reduce the net level. And I will still repeat in this call, in every call I have said that our target for the next phase of growth will happen when our debt level comes down between 3,500 to 4,000 crores. We are committed to that, and as the year progresses and the quarter envisages, our numbers will come down to the number which I have been mentioning, and we will come with the growth plan around that time.
Okay, sir. Let me explain why I ask you. If you look at from the March end, so in the 6 months, you have increased 350 crore rupees of net debt, and what I wanted was, what's the year-end target you are looking for? So the March, 24, what you are looking for?
I'm sure you're tracking the cement industry. When you finish Q4 end, obviously Q4 end, the working capital release are big time. The collections are big time in that quarter, and hence every company, the debt levels and the working capital levels will be lowest in the month of March. And when you come to September, because of the season build-up from October to March, all of us stock up with clinker, cement and fuel. Our clinker and cement stock, when compared to March to now, has increased by 100,000 tons between clinker and cement, and fuel stocks are at 70,000 tons in September. You will watch us in December 31, there's a quarter 3 call, and you will watch us in quarter 4 call. This number will come down, and we will see it in the coming 2 quarters.
Okay, sure. So I'll wait for that. Coming to my second question, so on the combined raw material and power and fuel cost, if we look at, your power and fuel cost went down, but your other raw material cost increased. In the opening presentation, ma'am was saying that you had to buy some clinker. So just wanted to ask what percentage of that your raw material cost is clinker, and given it's a seasonal quarter, was not the clinker built up as an inventory in the first quarter, and why normally your raw material doesn't increase that much in the second quarter? So what was the change this year?
Sir, we are unable to hear you.
Can you hear me now? Is it better?
Yes.
We can hear you. Power and fuel cost in Q1 and Q2 was 1219 rupees. But when you dive deep into the 1219 in Q1 and Q2, and when you split the power and fuel cost into fuel cost and power cost, the huge amount of drop has happened in the fuel cost of the company from 850 rupees per ton in Q1 to 798 rupees per ton in Q2, a reduction of 52 rupees in the fuel cost of the company. In the same period, power cost went up from 369 to 421, an increase of 52 rupees, and hence we are at more or less flat at 1219. The reason for power cost going up in Q2 versus Q1 is due to the shutdown as well as the debottlenecking activities in a couple of our plants in Rizda and Nimbol. We had to shut the WHR as well as the CPP, and we had to buy grid power, and hence the power cost went up. But the efficiency of the kilns and the programs of the company to reduce SHC and also to maximize AFR has resulted in fuel cost reduction from 850 to 798. Hence, the first part is drop in fuel cost. Power cost went up temporarily. You will see the Q3 numbers. There will be a reduction in Q3 power and fuel cost when compared to Q2 power cost based on the efficiency factor as well as the WHR and CPP. As regards the raw material, where you asked the question, why the raw material cost has gone up, and because of the clinker purchase, what Meeta has spoken in her opening remark. As regards the amount of clinker we sourced during Q2 when compared to previous quarters, about 50,000 tons of clinker to ensure growth ambitions. And the number 50,000 tons of clinker was purchased in North to fuel the North growth. Hence, North has grown double digit and we incurred cost by clinker at 50,000 tons. And that's the reason for the raw material cost increase.
Okay, sir. I have another question. I'll join the queue and come back. Thank you.
Thank you, Jashandeep.
Thank you. We have our next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good evening, team. My first question is on the cement pricing in East. We have benefited to some extent in September month during the last quarter. The question is around, there were like 2-3 rounds of price hike which were attempted in September. So has some of it got rolled back in the month of October for your case? Or is it like largely sustaining and the full benefit should be realized in third quarter?
Prateek, firstly to set the perspective, exit to exit basis, we have seen about a 7% increase in East, primarily because this price increase came in the month of September. So, through month of September and October, there have been the natural blips of up and down, but the prices seem to have stabilized. It's early in the quarter. October, as you know, was a festival month and disturbed in some parts of East, but we are definitely seeing the pricing situation stabilize. We'll have to see how it pans out still with 8 more weeks to go to the quarter.
Suffice to say, the November pricing is almost equal to October pricing. So as of now, we are able to hold prices in this quarter.
So the October pricing is stable versus September in your case, as you said.
Yeah, obviously, as Meeta said, there has been ups and downs in price from September till end of October. But net, we have benefited out of pricing, and then as we enter November, we still are able to hold on to our prices.
Right, and when we say that like we have like sort of high premium mix and focusing on further premiumization, and the prices are better by 15-35 rupees. So on the profitability, how is it different for like these products versus like normal products on a per ton basis?
So Prateek, I would not like to go into a brand by brand discussion, but I'd like to mention here that the company has a price acceleration program, which is KPI driven for an improvement just through the premiumization lever of up to INR 50 per ton. So this comes out of a mix, the focus on continuous increase in the premium share, as well as unit to unit price difference between base product and premium range.
Sure. And one last question on your CapEx. So, we see right now our CapEx is, net debt is seasonally higher, but maybe we can assume like by the second half of FY25, we may like start to see some work happening on the West project or North project in terms of expansion.
Yeah, I guess current year CapEx is, like in last call I mentioned that FY24 CapEx is for the tune of about 100 crores. These are all basically the brownfield expansions in Haryana, Nimbol, Risda, and then the siding projects and the routine CapEx in the factories. All of it is about 600 crores this year, out of which H1 we have done about 300, and then we're looking at about 300 in the balance 6 months in H2. Next year, in terms of these projects, all of them will be completed by March, April FY25. But as I mentioned a few minutes ago, I'm really looking at debt reduction in this period of 6 to 8 months, and when the debt comes down, hopefully, fingers crossed, we'll come back and announce our growth plans. If we are able to shave off that number and the industry and overall market scenario is favorable to in the next 6 months, which we are optimistic. So there is good possibility that we can come up with the plans.
Okay. In your annual report, it was mentioned that we will be kickstarting the capex in FY25, if I remember correctly.
Yeah, I'm very clear. I guess if you really look at whether it be Q1 FY25 or Q2 FY25, I think a little bit far-fetched to say at this point of time. But as we come closer to the date, and I think every passing quarter with the strength of performance continuously improving, if you've seen our company in FY23 and FY24, every quarter YOY we have improved over the previous year's quarter's number. I think we will continue to maintain this trajectory going forward, and we are in a good spot to get our growth plans going once the debt numbers come below 4,000. And that, in the best possible scenario, could be early part of FY25.
Sure, sir. These are my questions, and all the best.
Thank you, Pratik.
Thank you. Ladies and gentlemen, we request you to restrict to 2 questions at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you, sir. Sir, to put it simple, so current average October realization for us in East, if I compare with the 2Q average, how much is higher on per bag basis or per ton basis?
Shravan, how can I tell October number now? The quarter has just started. Q2 number.
Broadly, sir.
Let me answer you in a different way. In one of the previous questions, I mentioned that the pricing in October is holding, November is holding as vis-a-vis October. So suffice to say, realization will also hold in the month.
Okay, because why I was asking is because we have seen a 70 odd rupees kind of attempt in September hike. Out of that, 50-55 rupees got absorbed, and now again we are seeing a 17-15 rupees kind of a rollback. So there is in gap the price got increased in stepwise. It is getting rolled back. So that's what I was broadly trying to understand, because that's the major thing in terms of increasing our profitability in the third quarter, and that is a major driver in terms of achieving our net debt reduction. And that's why broadly trying to understand how one can look at least 10-15 rupees kind of increase in per bag for third quarter versus the second quarter. That's the broader I'm trying to understand.
I cannot comment on the first part of your question. I will only comment on the second part of your question, which is about whether our realizations in Q3 will be better than Q2. Certainly, our realizations in Q3 will be better than Q2.
Okay, got it. Second, just on the expansion, whenever we will do whether Q1 or Q2 FY25, when we will be reaching up less than 4,000 crore net debt, as you mentioned. Last time we talk about close to maybe a 1,200 to 1,400 crore kind of capex we are looking for the Rajasthan expansion. So for that, how much capacity are we looking at the clinker and at the grinding level, broadly, roughly?
Yeah, I guess there are two models we are looking at, whether we should go for a 6,000 TPD line or 8,000 TPD line. So we still started our engineering work to estimate the designs because it's brownfield expansion. The Chittor plant, originally when we put up, it was designed for a 2-kiln configuration in terms of layout and the overall infrastructure in the plant. So I guess with that in mind, that's how the engineering design is being worked upon. So closer to the date, we will decide whether we will set up a 8,000 TPD line or a 6,000 TPD line. But certainly the current line is 6,000 TPD line. So as an engineer's answer, I would say it's better always to have similar kind of equipment so that we're able to get standardization. But certainly business decision will come in the front of engineering decision. So we will make a decision closer to the date whether the 8,000 TPD line will fit there with the maximum benefit for infrastructure or a 6,000 TPD line. But one of the two will happen.
So on a grinding level, it would be a close to 3.5-4 million ton kind of a grinding, considering the 1.77 or 1.8 kind of a CC ratio.
It's not like that. So 6,000 TPD line would be about 2 million tons of clinker, and 8,000 TPD line will be close to about 3 million tons of 2.8 million tons of clinker. So the CK ratio in north is far lower than east. So while our asset was, Peter mentioned, and we have been mentioning that our OPC is a non-trade route. OPC route will come down as a company because we want to maximize the installed capacity. Even at a very conservative number of about 1.6 times, we can look at 2 million tons would be 3.2 million tons of cement and 2.8 million to the 4 million tons of cement. Certainly the grinding unit will not be inside Chittor, it will be a split grinding unit. And here again we are working whether it will be in Western MP or it will be in Western UP based on a fly ash source model.
Lastly, sir, data points, lead distance, Kcal cost for this quarter and the fuel mix for this quarter.
Okay.
Fuel mix, since the fuel cost came down by 7, the fuel mix for the quarter 2 was 1.77. For the same period in Q1, it was 1.83 became 1.77. And in Q3, I guess this number will come down even a little bit more than 1.77. In terms of lead distance, we have been able to reduce lead distance by 8 kilometers in quarter 2 versus quarter 1.
So petcoke, imported coal, linkage coal share was how much, sir, for this quarter?
Okay, yeah. Granular details, if you want, I can rattle out in Q2, petcoke 47%, imported coal 1%, non-linkage, domestic 12%, linkage 25%, and that's it. AFR 14%.
Oh. Thank you, sir.
Thank you. We have our next question from the line of Sanjeev Kumar Damani from SKD Consulting. Please go ahead.
Thank you for the opportunity and good afternoon to all you and my respect for you all as leading management operating such large cement plants. Sir, my question is one regarding the efficiency of our plant on energy side. So can we say that we are most economical today or are best comparable to the industry standards? I want your comment on this, please, sir.
Can you restate the first line of your question? If you restate the question one more time, I'll catch it, please.
No problem, sir. Actually, it is regarding, our efficiency, energy efficiency of our plants on fuel side as well as power side. So are we most economical producer of cement or we are still to do something to get most economical?
Okay. In our industry, if you really look at, there are 3 energy levers in the company. One is the kiln SHC, then you got the clinker SPC, and then you got the grinding SPC. And Nuvoco is uniquely placed with all our kilns. We got captive power plant, but that's nothing to do with energy efficiency. Just a sound decision to ensure that we are able to generate our own power from coal rather than buying from grid power, because grid power is expensive. The second one is how do we reduce the specific heat consumption in our kilns? We have got a multiple generation kilns in the company. The oldest kiln is made in 1984. The youngest kiln is installed in 2016. So that's the kind of, the 6 kilns are like 40 years from each other. But the youngest kiln runs at 685 kilocal per ton of clinker, which is easily one of the best in the industry. This is a 6-stage preheater, and it's similar, comparable to any other energy benchmark in the industry. We also have a 2013 installed kiln at Chittor, which is not it's a Chinese design, but then that kiln has made giant progress in the last 2 to 3 years, and it's been able to match the 2016 kiln at, it's also running at 688, 689 kilocal per ton. I think these two are our flagship kilns. The Sonadi line 2 is also about 700. So suffice to say, our blended SHC for the company is anywhere between 702 to 710. If you really look at the average of us with the best in the industry, average will be more than best in the industry. But 2 kilns in our company will be equal to the best in the industry. That's on the specific heat consumption. Again, in terms of power, we have got multiple designs. We've got ball mill, we've got VRMs. So I guess the VRMs running in Jojobera as well as our Rizda plant are operating at 30-31 units per ton of cement, and that's again almost equal to the best in the industry. Our ball mills operate at 26-27, again that's also fine numbers. The unique factor which Nuvoco has, which we are very proud and one of the energy efficient companies in the industry, comes from our WHR systems. We have WHRs which are fitted in all our kilns, and the installed WHR capacity is about 45 megawatt, and in the entire industry we are at 2:1 installed capacity to WHR, which is I won't be able to exactly compare with every other competition, but suffice to say we should be 1 or 2 in this. And last but not the least, in terms of alternate fuel consumption, against a global benchmark, we are in Indian benchmark of 12%, 8%, we are at a 14% in India. Easily, we are better than the Indian average. Global average is about 20% AFR consumption. We are at 14%. But once the Nimbol and the Rizda factories scale up, our AFR usage will be also excess of 20%. So with AFR at greater than 20%, WHR is at 45 megawatt, CPP in all the kilns, and the 2 kilns which are running at SHC 685, 688, suffice to say will be one of the best in the country in terms of energy efficiency.
Thank you very much, sir. And I hope, whatever is still to be done, you must have in your mind to correct it. Second question is regarding capacity utilization. I noted during the discussion that we produced 45 lakh tons in this quarter. I noted that you have a capacity of 1.9 million ton in the east and rest is in the north. So can I know the capacity utilization in the last quarter in north as well as in east? Can you kindly?
Okay, so 23.82 million tons is our current installed capacity. If we have to do quarter by quarter, so roughly 24 by 4 is 6 million tons of capacity, and out of which if I did 45, we are operating at about 70% capacity utilization in Q2.
Okay, but can you capacity utilization out of 1.9 and how much is on the north side?
Right now, I'm not having the exact number, but I guess if you reach out to our investor relations, they will be able to give you capitalization in east and capitalization in north. But as a company, we were at 75% in Q2. But come Q4, our old DNA of the company is operating at 90% capacity utilization. So you will see us go back very quickly from a test match to a ODI to a T20 mode very quickly.
Thank you. We have our next question from the line of Urmik Chaya from Asian Market Securities. Please go ahead.
Just one question. Clinker needed to be bought in north because of kiln shutdown due to maintenance during monsoon month. Isn't it a normal every year recurring features that in monsoon the kiln shut down and companies pile up clinker stock during the previous quarter? Another reason I ask is CC is obviously lower than east. You don't have Concreto in north. And in terms of pricing, I don't think you are among the top 5 in the region. You saw from the northern plant. So isn't that a substantially negative for margins?
Okay. first answer to your first part, this clinker purchase in North will not be an annual phenomena. It was only a unique phenomena for this year simply because we had to take a 45-day shutdown in Nimbol plant for annual shutdown plus the bottlenecking project which was happening there. We needed 45 days to fit the various other parts to ensure the line capacity went up to 6,000 TPD. So it's a one-off thing, it will not happen. But rest of the years, we don't buy so much clinker at all as to run our company. We always have our own clinker to run our company. At 4 million tons of installed clinker capacity in North, we will make 6 million tons of cement. That's the kind of number we have for North. That's the installed capacity. As regards your second question of Concreto, we don't have any plans to launch Concreto in North. Concreto is a uniquely slag cement, which is unique to East, and then that's where we are market leader. North, our premium product comes from Duragard microfiber, which our marketing head said Mita about patented product, which is unique. So that's our premium product offering in North. As regards pricing in North, we are just 8-9 years old company in the North. I guess our entire DNA is to run a premium products company. More and more Duragard microfiber will sell in the market in the North region in the coming years. And certainly our ambition is to get into top 3 of pricing in North in the near future.
Thanks, sir.
Thank you. We have our next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi. Thanks for the opportunity. So, just on demand in East, like we have seen last 2 quarters being quite soft in East. Could you highlight what has pulled down this trend of strong demand in the region, and what's the outlook for the region?
Thanks, Amit, for the question. We have also addressed this in our previous calls. Right from Q4 of last year, demand has remained soft in Bengal and Jharkhand initially, and last quarter we saw Bengal and Bihar. So Bengal has remained on the lower side, and that is why even in my speech I made a reference that we continue to remain bullish looking at the potential in West Bengal, particularly release of funds for PMAY projects has a very favorable impact on our business, which is IHB or individual home builder or trade-driven business. So we will just have to see. We remain optimistic that when this demand opens up, when funds flow improves in the market of West Bengal, we are sitting on some good potential there.
I guess it's a temporary phenomena. I guess it's been there for the last 3-4 quarters, but things should change in East because the reports about cement industry for the future, if we look at the regional growth plans and any released report by all the research houses and analysts very clearly says in the next 5 to 10 years, East will be continuing to grow at 8-9% CAGR. So overall industry will be about 7%, East will be faster than the industry. But that's not come true in the last 2 quarters. But I guess all this is based on the base data of infrastructure, roads, PMAY, and the rest of the underdeveloped part of India is largely located in East. So, and that's one of the reasons why a lot of capacities are coming in the East, and the entire industry is looking at East as a growth engine for the infrastructure and cement industry, and things should certainly improve in the coming quarters. Sure, understood. And your freight cost has been quite volatile. I understand part of it is because of rail rakes availability and all that. But is the situation now stabilized on rake availability, and what's the plan to mitigate this volatility in freight cost? I think freight cost is a function of external levers and internal levers. The external levers are all coming out of the fuel price, as well as the second one is all about rail freight and rake availability. Rake availability, we are constantly knocking at the doors of Indian Railways to release more rakes and ensure that the wagon supply is adequate for us. As you would know that Nuvoco has got a relatively very good index of rail share in the overall East market. The other thing, for us to exploit this advantage is the reason why we are setting up railway siding in our Orissa cement plant in Jajpur and extending the railway siding in Sonadih so that we are able to get the benefit of it. And you would know that if you have more and more siding, then the allocation of rakes from the Indian Railways is a little bit of a formula driven based on the sidings one has. And with these two sidings coming in, we should get more rakes for clinker and more rakes for wagon. So that's the external factor. As regards the fuel cost as well as the freight rates, very difficult for us to comment. That's all now open market rates for fuel, and then as and when the fuel rate changes, the overall freight rate increase. But the industry also works with the formula for how much of defraying the fuel cost and the overall freight rate. It should be okay for everyone. But having said this about the external levers, what as a company we have to focus and are focusing is based on two other levers, which Madhumita mentioned about the bridge program. One of it which we can certainly do is increasing the geo mix and reducing the lead distance. In this quarter, we are able to reduce the lead distance, but our aim is to reduce the lead distance in East by minimum 10 kilometers in the medium to long term. That's one of the biggest agenda which as a company we are driving. The second lever which we have is to increase the direct dispatches and circumvent the STM route. And here we see a huge opportunity, but it is going to be a challenging one because we got to change the trade practice. But nevertheless, we are committed to take the low-hanging fruits in those states where we can migrate from STM route into SO route. We are already set targets to move to about excess of 55-60% as a blended company. But in the long run, even 60 is not a good number. We should have an ambition of going up to 75%. And we can unlock 50 to 60 rupees out of secondary dispatch freight cost. So freight cost reduction, increasing rail movement, and reducing lead distance, all these are the big agendas for the company in the medium to long term.
Got it. Thanks for the detailed response. And also, like you mentioned, the cement capacity is going to 25 MT after the Bhiwani grinding unit. Similarly, what is the clinker capacity now with the debottlenecking that has happened at Risda and Nimbol?
North, our installed clinker capacity is 4 million tons, and East it is 13.5 million tons. 9.5 million tons, I'm sorry. So overall, as a company, we'll have 13.5 million tons of clinker, and the corresponding CK ratios will land us to 25 million tons.
So this 13.5 is all operational now, right? I mean, the debottlenecking is all completed now.
Clinker is all operational. Grinding, Bhiwani is under commissioning, as we mentioned a little while ago. By end of Q3, mill will be running at full speed, and then packing lines will come around December, Jan. So by end of this next year, we can safely say we are moving through for 25 million tons.
Got it. Thanks a lot. Yeah.
Thank you.
Thank you. We have our next question from the line of Parth Bhavsar from Investec. Please go ahead.
Hello. Yeah. Thank you for the opportunity. Now, I wanted to understand that we've done quite well operationally. It's just that the other expenses, has shot up by 150 rupees per ton on quarter basis. So I believe this would be on account of the maintenance shutdown that we have taken, right? But is there anything else besides the maintenance shutdown?
Hello. Just a second. Just give us a minute. We are just recalling that sheet.
Quarter 2 to quarter 1, other expenditure increase is totally a function of the shutdown as well as the shutdown expenditure of the company.
Okay. So nothing else, right? So this will normalize going ahead. It will come down to in the range of maybe 700 to 750.
You're not audible.
I'm sorry. That is the only reason for Q2 to Q1 other expenditure increase. So okay. This will come down the moment our shutdowns are already completed, and in Q3 this number will come back to normative levels.
Okay. And just, sir, can you help me where the shutdowns were taken? If you could just name the plants.
6 kilns, so we have completed shutdowns in 5 out of 6 kilns. Even in the 6th kiln, in the month of September, we have done part work. So for the year, more or less, our shutdown is kilns is done and out. Mills, almost all mills are done. There are 2 ball mills in 2 4 plants where small cost shutdowns are there, but that's not going to impact results for this year at all.
Okay, so shutdown at the kilns is done. Like, and also wanted to know, like, how many days that these kilns were shut down for?
That will be very difficult for me to remember every kiln how many days. I only remember the Nimbo shutdown because I was personally monitoring. It took 45 days for us to shut down the kiln and debottleneck for 6,000 TPD.
Okay. Okay. That's it from my side, sir. Thank you so much.
Thank you. We have our next question from the line of Naveen Sahadev from ICICI Securities. Please go ahead.
Yeah, good evening and thank you.
Sir, can you speak a bit louder, please?
Yeah, sure. Is it better now?
Yes.
Yeah, thank you so much. So thank you for the opportunity. So my first question was regarding the repayment schedule for or towards acceptances. So what I gathered from the annual report is that of the total trade payables of 1,700 odd crore, roughly 1,467 crore is due or payable within less than a year. So my question was that are we likely to get a rollover of this acceptance facility or this trade payable facility, or this can see a meaningful decline, more like 1,100 odd crore of normalized levels that were there prior to the spike that we saw last year?
So thanks, Naveen, for the question. So basically, this trade payables is all about our negotiated terms with the vendors, both on the raw material side, fuel side. So given the seasonality, so this is on a higher side, and we have been able to get better negotiation on this payment terms. And as the volumes pick up, this may go up, but obviously it's not going to go down to 1,100 level for sure in the Q3 and Q4.
Right. So, no, it's great. I mean, if you can get that kind of a credit facility, it's definitely great. I'm only trying to understand if there is a repayment due to it.
So there's no repayment per se, as I clearly mentioned. So, Naveen, just to be more specific, so in fact, and I've been talking about it in the previous quarters as well. So working capital management has always remained a paramount focus for us at Nuvoco. And on the side, we have been continuously negotiating our payment terms with the lenders and trying to see as to what sort of payment terms can be given to us. So this is both through the routes of the trade financing of LC, BGs, and also the open credits that we enjoy given our position in the market. So that's
great. This is absolutely great.
Trade payable.
No, this is absolutely great, and congratulations to you for doing such a great negotiation there. So my second question, just a confirmation. In response to the call a couple of turns back, did Madhumita ma'am say that the exit price or the exit realization for September quarter was 7% higher versus the average for the quarter?
No, I mentioned the quarter to quarter, June exit to September exit.
Okay. September exit was 7% higher versus June. I get it. So which means...
Sorry, Naveen, as I mentioned, the price was... increase was realized in the month of September. That is why an exit to exit comparison.
Of course. But that's great. Thank you so much.
Thank you. We have our next question from the line of Tejas Pradhan from Citigroup. Please go ahead.
Hello. I heard on the call that you mentioned North saw 14% volume growth in this quarter, 2Q. Can you share the same number for the East?
East has been very marginally lower, and we have a little bit of business in center. So between East and center, we've been about 1 to 2% lower.
Okay, thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Ms. Madhumita Basu for closing comments. Over to you.
Thank you, Yashasvi. So in conclusion, firstly, thank you all for attending the call and for your questions. Cement demand is expected to be driven by housing and government-led infrastructure development projects. We continue to remain optimistic on the potential demand uptake from pending PMAY and infrastructure projects in East. We continue to focus on operational efficiencies and remain committed to our growth projects. As clarified with an early closure of the earnings call, we look forward to being available for any clarifications and further discussions that you would like to have with us. Thank you once again for joining us today. Wish you all a happy Deepavali and a prosperous New Year.
Thank you, ma'am. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.